We have countries with tremendous deficits with us where we have, where we essentially lose a lot of money. And we are changing that around very rapidly. And I think it's about time somebody did it.
Hello and welcome to the week ahead on Nomura Podcasts. I'm your host, Andrew Tysest from our Global Markets Research team, and today's Friday, the 11th of July. Key global market themes remain centered around US tariff announcements, possible trade deals, and the Fed. This week, we saw President Trump announce higher tariff rates on a number of countries, with a 50% tariff on Brazil and a 50% tariff on copper too catching attention. You heard a snippet there from President Trump, courtesy of Bloomberg TV, continuing to make his case. And Trump has continued to put pressure on Fed Chair Powell, suggesting that he could announce a successor, and saying that interest rates should be much lower, as you'll hear shortly. Now, to get a handle on these developments, what comes next, and key data and events to look out for over the coming week, we're going to take a quick world tour. We'll be checking in with Jeremy Schwartz from our US economics team, George Buckley in London, Hannah Liu from Nomura's China research team, and Nabila Armani from our AEJ team. We'll also have a quick look at coming Japan inflation data and the monthly jobs report for Australia. There is a lot going on. I think I said that last time, but it's still true. So let's dive in.
We have inflation now totally under control. We have a Fed chairman that if he was doing his job properly would lower interest rates. But you want to see a rocket ship? We should have the lowest interest rates because without us, there's nothing.
So let's start this week with the US, and I have Jeremy Schwartz here from our US economics team in New York. Jeremy, thanks for stepping up again.
Yeah, great to be back.
Thank you. Now, June CPI data could be the key economic report next week. Recent inflation readings have seemed somewhat tame, but could we see signs of stronger inflation with this one?
Yeah, so we do think core CPI inflation likely picked up modestly in the June report, but probably fell short of really showing a broad tariff impact. So we're forecasting an acceleration in the monthly reading up to around 24 basis points, up from 0.13 in May. And we do think you're going to get some sporadic signs of goods price pressure. So the Adobe Digital Price Index suggested that several tariff-sensitive items, such as apparels and sporting goods, potentially rose in the month. That said, vehicle price inflation seemed to remain subdued, and we think there wasn't too much sign of broader base price increases. Things like consumer electronics still seem to be seeing relatively modest price pressures. At the same time, we think that you do get some rebound in rent as well as supercore services. So overall, it's consistent with inflation still clearly running well above the Fed's target, but not necessarily an eye-popping number that's clearly signaling a inflation problem from tariffs. Based on our forecast for the PPI as well, we're expecting core PCE inflation likely rebounded to just between 28, 29 basis points month on month in June, up from 0.18 in May. So overall, considering the recent resilience in the labor market, we think the Fed is likely to stay on hold at the July FOMC meeting, despite the little evidence of tariff-driven inflation. But many policymakers have really emphasized the next couple of months of inflation data for assessing the impact of tariffs. We think that price pressure is more likely to materialize as you head into the July and August inflation prints.
Okay, so some somewhat higher inflation readings next week and possible signs that tariffs could be contributing to that. And hey, speaking of tariffs, we have had some announcements over the past week, 50% for Brazil, and it seems 50% for copper too. How serious is that? And is it impacting your thinking on the outlook there?
Yeah, so you've had a number of trade partners now receiving letters unilaterally setting tariff rates from the Trump administration. And for the most part, these letters are setting rates quite close to the Liberation Day levels from April 2nd, the ones that were postponed supposedly until July 9th. So I think the optimistic interpretation here and the market's view on it is that this is just another extension. They're just kicking the can further down the road and nothing has fundamentally changed here. we're quite skeptical on that front. And actually, we do think that there's increasing risk that you do see a number of trade partners end up substantially higher than the 10% across the board reciprocal tariff rates, which have been in effect since April. Notably, beyond the letters, we would actually focus more on the trade deal announced last week with Vietnam, which sets tariff rates at 20% with a 40% additional surcharge for any transshipments from China. Despite the fact that Vietnam did make notable concessions on their trade restrictions, as well as some purchase commitments for U.S. goods. This tells us that, again, even for trade partners that come to the table that potentially make offers, there's a risk of seeing tariff rates kind of well in excess of that 10% level and settling somewhere in between that and the Liberation Day, substantially higher levels. So it's not necessarily that we expect all of these letters to go into effect on August 1st, but I think just the fact that you're seeing that higher country-specific tariff rate coming into the negotiations raises the risks that you do get something higher than we were anticipating for effective tariff rates. Our baseline is around 15%. We think high teens, low 20s is looking increasingly plausible if these are the kind of numbers the administration is throwing out now. Finally, you mentioned the copper tariffs as well. Those Trump has indicated could rise up to 50%. Again, that's not a huge share of imports, but I think probably more importantly than that, he's also signaled that sector-specific tariffs on pharmaceuticals and semiconductors and consumer electronics could potentially be announced relatively soon as well. The semis exemption in particular has been notable for keeping tariff costs under control for a number of trade partners. That's a major import item, and it's a major factor in consumer price pressure. And then on pharma, again, exactly how they structure it in terms of the timing and any exemptions for major trade partners will be important. But that's another factor that could lead to some consumer price inflation down the line as well. So again, not much has changed fundamentally over the next couple of weeks, but I think the hawkish rhetoric has clearly picked up. The administration is clearly in an escalating mood. And even if we don't think that they'll implement exactly what they're threatening now, it does seem like risks are rising of something substantially more aggressive than our base case.
Well, there's clearly a lot of moving parts there, and that escalation you mentioned is notable. Jeremy, thanks so much for keeping us up to speed.
Yeah, thank you.
Now, moving to Europe, I'm very pleased to be joined again by George Buckley, our Chief Economist for UK and Europe. George, welcome back.
Hi, Andrew.
Excellent, thank you. Look, let's start with the UK this week. We've got CPI and a labour market report to look out for. We've had some focus on fiscal matters over there, and we've seen higher UK bond yields. It looks like there's a lot going on in the UK, George. Any thoughts around some of those things?
There is indeed things keeping us busy over here. And as you say, a couple of pieces of data next week. We've got the CPI numbers. I'm not sure they're going to be the most important thing this week, but certainly worth watching what's happening to services inflation. We think it's going to nudge a little bit further down, but 4.5%, it's still a little bit too high for what the Bank of England would like. Labour market report, well, I mean, as you know, there's a huge amount of data contained within this report. Some of it not all that helpful. I mean, you get the LFS employment data and unemployment data. That has had a lot of problems, of course, recently in terms of the survey. You've got payrolls, which are super volatile and get revised a lot. There'll be a lot of focus on the wage data, though, particularly in the light of what's been going on with changes to national insurance and also the national minimum wage. But I think probably one of the most important things next week for the UK is going to be fiscal policy. The Chancellor speaks at the Mansion House, just round the corner from Nomura's office. I walk past it every day. She'll be speaking there on the 15th, on Tuesday. That's going to be a big focus, just purely because how much interest in UK fiscal policy there is right now. Personally, I think a lot of the concern about fiscal policy is maybe a bit overdone, largely because every time there is even the smallest miss of the fiscal rules, the Chancellor has to go and do something about it. So there's a huge amount of press focus on that. You look at some European countries, they are in far worse a state. France, for example, much higher debt, much higher deficits.
Right, and just thinking of continental Europe there, I guess we have to keep an eye out for tariff news and trade agreements. The situation's obviously pretty fluid and uncertain. As we record this, and it's Thursday morning London time, we haven't heard any news. But how do you think this one could play out?
Well, I think there's a bit of hope now. We haven't seen a letter as of the time we're speaking, Andrew, from Trump to Europe. That's good news. There's an ongoing discussion between the Commission and the US about what sort of tariffs could be in place afterwards. It looks like, and there's a hope that it's going to be 10%. Never thought we'd be saying that it's a hope that it's 10%, but certainly 10% would be a big win, I think, for both sides. But we'll see. It would be encouraging if that's what we got and nothing worse.
Okay, I'm hoping for 10% for Australia and New Zealand too, by the way. Now, just on all this tariff issue and Mr. Trump's policies and uncertainty, we have seen the US dollar move lower this year, and Euro's been making some highs up around 117, 118. It looks like that's becoming a focus for the ECB. Is that a concern, and is that something that could impact the policy outlook there?
Sure, and there's a couple of focal points here. One is that, stronger euro, it's great. This is a shift away from the dollar as a reserve currency towards the euro, and I think that's got some way to go potentially. But I think the other issue is, what does a stronger euro against the dollar mean for policy, as you rightly ask? And I think that the key question there is what it does to inflation and growth. When you see a rise in the euro, it's effectively a tightening of financial conditions. The ECB calculates that it takes roughly 0.4 percentage points for every 10% move in the trade weighted off inflation. So this will have policy repercussions. It could mean weaker inflation. It could even encourage the ECB to cut a little bit more. We do think they'll cut more. We've got 2 more cuts in our profile by the end of this year. I think these moves are supportive of that.
George, great to speak with you. You've covered a lot of ground there. Thanks so much.
You too. Thanks, Andrew.
Now, moving to China. I'm lucky to be able to chat today with Hannah Liu from our China research team. Hannah, welcome.
Hey, Andrew, it's great to be back.
Excellent. Thanks so much. Now, we have some important activity data to look out for in China next week, some monthly data and Q2 GDP as well. Could you take us through your thoughts on some of that?
Of course. So for China, we have really a bunch of data released to be released early next week. First of all, we have the trade data on Monday, and then we have a bunch of activity data on Tuesday. And we also very likely have the credit data, very likely to be released in also during these 2 days. So let me just pick something interesting to discuss here. So the first and foremost is on trade data. We expect the export growth to increase to 5.3% year over year in June from 4.8% in May. Largely because June is actually the first full month after the Geneva tariff truce. So if there's any front loading to the U.S. shipping, it could be fully reflected in June. And however, on the other side, we see the activity data is likely to show pretty much a broad slowdown. In particular, I want to touch on the retail sales and also our forecast on Q2 GDP. So we expect the retail sales growth to slow to 5% in June from 6.4% in May, despite a very low base from last year. And we see several reasons at play here. The first reason is, there's the e-commerce promotion sales, this big festival, which usually take place in June, but it started earlier. It started in May this year. So it could boost the May retail sales already, but likely see a pullback in June. And the second reason we see of a slowdown is this new austerity rules imposed on the government officials and SOE managers, the so-called 体制内人员. So these new regulations, they are not only prohibit any alcohol and tobacco at any official meals, but they also play as the de facto prohibition for them to die out, even for personal reasons like families and friends gatherings. So this could certainly dampen the catering sales and also, of course, the alcohol sales. And the final reason is what we are all very familiar of is the China's so-called trade-in program. So we see already the government subsidies for the second quarter are used up largely by the end of May. So there could be some funding draining in terms of the June data. And for GDP for Q2, we expect the Q2 GDP to slow to 4.8% from 5.1% in Q1. But despite the slowdown, honestly, it's actually a decent growth number. It's the second half of the year that we are really concerned about.
Okay, got it. Yeah, so some caution there in terms of the monthly data, and H2 you just mentioned there. As we look out towards the second half of the year, you're expressing a cautious view there. Can you take us through that in a bit more detail?
Yeah, of course. So for China, talking about our cautious view on on H2, it seems like a deja vu all over again. So over the past few years, we have observed these first half, so associated with these optimistic expectations for a sustained stock market boom and also a decent growth recovery. However, right after the mid-year, things didn't quite go as expected, and Beijing rushed into came to rescue. And this time around, we see a demand cliff on multiple factors. And the first is the consumption side. We see the consumption is dampened by the new austerity rule that I mentioned before, and also the eventual payback from the strong durable goods sales that is bolstered by merely the government subsidy. And on the second front, we see the investment demand could be squeezed this time around, largely because of the new round of the supply side reform, which aims to cut the excess capacity, especially in the green energy sector. So in the long run, this could be a good thing, but in the short run, we see the investment demand could be dampened. And thirdly, the demand cliff could come from the export sector. So not only we see a slowdown to the U.S., but also to other countries. To the U.S. side, we see despite the tariff truce, the tariffs are still high. And also we see a lot of payback from the front loading and also the ending of the small parcel tariff fee loophole. And to the other countries, we see the chance for a third country rerouting to the US is likely to be less possible because other countries are very eager to strike trade deals with the US. And also the recent souring relationship with the Europe indicate a less of an alternative markets outside of the US. And lastly, the last reason for the demand cliff could come from the property sector. We see recently, seems like the property crisis is broadening and worsening again based on some high frequency new home sales and home prices data. Yeah, that's our view on H2 outlook here.
Wow. So a couple of reasons for caution and deja vu all over again. Hannah, thanks so much.
Always. Bye.
Now, today we're going to mix it up a little and take a look at Indonesia. And I have for the first time Nabila Armani from our AEJ research team here with me. Nabila, welcome to the podcast.
Hi, Andrew. Great talking to you.
Excellent. Thank you so much. Now, we have Bank Indonesia meeting next week. What are they going to do and what are they going to say?
Yeah, thanks for the question, Andrew. So we expect BI to leave the policy rate unchanged at 5.5% as external uncertainty has increased again due to U.S. tariff policy. And we believe BI will become more cautious in cutting the policy rate in this environment, given its continued focus on FX stability. We're still expecting the statement to remain broadly dovish as before, with officials indicating again it will monitor room to lower policy rates. We're currently assigning a 60% likelihood to our on-hold forecast and a 40% to a 25 basis point cut, which BI could rationalize with the latest data releases showing softening domestic demand and below target inflation.
Okay, so on hold with risk of cut. Now, I know you've published a report highlighting that weak domestic demand, weak consumer spending, policy support being needed. Can you elaborate on that?
So we're expecting private consumption, which accounts for about 55% of the GDP, will likely remain subdued, held back by some fundamental factors, such as the labor market weakness and the pandemic scarring effects. First, in the labor market, we're seeing a rising layoffs in labor-intensive sectors, such as the manufacturing, and this is likely due to various factors. One of which is due to the influx of cheaper import goods from China, which is in line with other countries in the region as well. In terms of the share of informal workers, it has also risen again along with the rising layoffs. And this is a concern because people with informal jobs are likely to earn lower wages, which could reduce wage growth and negatively impact household spending as well. And secondly, we're seeing growth in key sectors to remain below pre-pandemic trend, such as the agriculture. The output growth of manufacturing sector did return slightly to the pre-pandemic rates, but beneath these overall headline, manufacturing subsectors remain weak. For example, growth in textile manufacturing, leather and footwear, chemical, furniture are still lagging. So that is why we're looking into fiscal policy support going forward will be stepped up, especially in the second half, and we continue to expect BI to lowering down rates by 50 basis points this year.
Hey, that's so interesting. Cheaper China imports, I heard you mention there. That's an issue for Indonesia and I guess for many others as well. That's a big theme. Hey, Nabila, thanks so much. Great to speak with you.
Great speaking to you, Andrew.
Now, elsewhere across the broad Asia region, I'm going to finish with just two quick highlights. In Japan, we'll be looking out for the June quarter CPI inflation report, as the inflation outlook remains important for the BOJ. Our team have the headline CPI rate easing 0.2 down to 3.3% year over year, but the BOJ's so-called core measure, that's the one that excludes volatile energy and fresh food prices, to rise by 0.1 to 3.4% year over year. And last but not least, my neck of the woods, Australia. June labour force data are coming. We expect employment growth of around 20,000 in the month of June and an unemployment rate which creeps fractionally higher to 4.10% from 4.06%. We continue to see signs of a gradual cooling in the labour market there, which could set the unemployment rate up by a couple of tenths over the next few quarters. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and expertly edited and produced, as always, by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more from Nomura's economists, researchers, or investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you get your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomurakonnects.com.